We begin today's deep dive with a significant analyst call rattling the legal tech space. William Blair has downgraded LegalZoom, and the implications stretch well beyond one ticker. This isn't a routine valuation trim. Blair is flagging a structural concern about how LegalZoom acquires customers at all. With the Nasdaq 100 already down 0.9% today, and growth-dependent platforms under particular scrutiny. When a firm with deep sector coverage pulls its constructive ratings citing channel-level uncertainty, the market pays attention. This is a story about the fragility of organic growth models across consumer-facing digital platforms. William Blair formally downgraded LegalZoom, with the core rationale centered on search uncertainty as a structural headwind to the company's growth trajectory. The firm's concern is specific: organic customer acquisition through search channels, along the backbone of LegalZoom's top-of-funnel strategy, is facing meaningful pressure. Blair's prior rating held a constructive view on LegalZoom's competitive positioning in the DIY legal market, but that thesis has now cracked. The downgrade explicitly flags deteriorating SEO dynamics and shifting consumer behavior as risks that call into question prior estimates on search traffic conversion rates and customer lifetime value. This is a model-level reassessment, not a sentiment call. For platforms like LegalZoom, organic search isn't just a marketing channel. It is the primary engine of scalable, low-cost customer acquisition. When that engine degrades, the company faces a binary choice: absorb lower growth or pay significantly more to acquire the same customers through paid channels, which compresses margins. Prior consensus had likely modeled steady search-driven growth as a structural pillar, and those assumptions may now be too optimistic on both conversion rates and customer lifetime value. This matters because the entire bull case for LegalZoom and similar legal tech and consumer SaaS platforms rests on the assumption that organic channels remain efficient and defensible against competition. The direct impact lands on LegalZoom, but the sector read-through is broader. Consumer discretionary and the legal tech subsector face immediate valuation pressure as investors reprice organic growth assumptions. Rocket Companies operates in adjacent financial services and similarly depends on digital acquisition efficiency. Sympathy weakness is a real risk if this downgrade signals broader deterioration in acquisition dynamics. Paychex, which serves overlapping small business clients through digital channels, could also see reassessment of its own customer acquisition cost structure. Meanwhile, Upstart, another platform where algorithmic and digital funnel efficiency is core to the model, faces margin concern spillover if search monetization uncertainty becomes a sector-wide narrative. The next major catalyst is LegalZoom's ability to demonstrate either resilience in search-driven traffic or a credible pivot toward alternative acquisition channels, such as paid marketing partnerships and referral networks. If the company can show accelerating non-search customer acquisition without a proportional increase in sales and marketing spend, the downgrade thesis weakens. On the macro side, watch the Nasdaq 100, already down 0.9% today, as a real-time gauge of appetite for growth-dependent tech and consumer platforms. Treasury yield pressure keeps discount rates elevated, which mechanically compresses multiples on long-duration growth names. Any further yield pressure would amplify the downgrade's negative impact on LegalZoom's valuation. Blair's downgrade of LegalZoom on search uncertainty is not an isolated stock call. It is a signal that the market should reassess organic growth assumptions across every consumer-facing platform where SEO has been treated as a durable, low-cost acquisition mode. As the Nasdaq 100 trades lower and the macro environment shows risk-off dynamics, the backdrop is not forgiving of business models that need to upgrade their assumptions. Investors should monitor customer acquisition cost trends, paid-to-organic ratios, and upcoming earnings commentary from legal tech and adjacent consumer SaaS names. That is the one story that matters most heading into the session today. Full breakdown is up. If this kind of analyst-level breakdown helps you trade smarter, hit subscribe and ring the notification bell. We cover every market-moving story, every trading day, with the depth you actually need to stay ahead.